Welcome to Harvest Financial Advisors Quarterly Update. I'm Marc Henn, CEO and founder, and this video update is for the quarter ending March 31st, 2026. In this update, I'll touch on what we've seen recently in the U.S. stock market and the broader economy, how consumers and businesses are holding up, the impact of rising geopolitical tensions and energy prices, what we're watching from the Federal Reserve and interest rates, and our continued focus on long-term goals rather than short-term headlines. Over the first quarter of 2026, markets moved through periods of both optimism and concern. We've seen days where headlines drove volatility and days where the focus returned more squarely to the underlying strength of the economy. From an economic standpoint, growth has remained resilient. We continue to see positive momentum in key areas like overall output and industrial production, and while there have been some pockets of softness, the broader picture still reflects an economy that is growing rather than contracting. Inflation, while not as elevated as it was a few years ago, remains above the Federal Reserve's long-term target in some areas. At the same time, employment has stayed relatively healthy, with many businesses still hiring and the job market remaining reasonably strong. One of the most important drivers of our economy continues to be the U.S. consumer. Consumer spending makes up roughly 2/3 of overall GDP, so how households feel and spend has a major impact on growth. Last year, consumer spending was up about 4.7%, and we expect it to continue to grow in 2026, even though that growth may vary by demographic group. Some consumers may feel more pressure from prices and borrowing costs, while others remain in a strong position, but overall the consumer remains a key source of strength in the economy. We also mentioned in our last quarterly update that we believe businesses would begin spending more this year. So far, we're seeing that play out as expected. Business investment has been improving, which is important for productivity, innovation, and future growth. Now, taken together, continued consumer spending and improved business investment support our view that GDP and industrial production are likely to remain positive through the remainder of the year. Of course, not all of the news has been positive. The tension in the Middle East has moved into more active conflict, and this has had implications for global markets and commodity prices. Roughly 20% of global oil is estimated to pass through the Strait of Hormuz, with more than 80% of that headed toward Asia. This dynamic allows the United States to be relatively insulated from actual oil shortages because of our own production and diversified supply sources. However, we are not insulated from global oil pricing, and we have seen oil prices and related commodities and stocks be quite volatile during this period. Now, with the economy growing and some supply chains already stretched, the conflict adds further pressure. We've seen that reflected not only in energy markets, but also in concerns around other inputs. For example, about 1/3 of global fertilizer supply is estimated to move through the Strait of Hormuz, which can have downstream effects on food prices over time. While the price at the gas pump may not be pleasant, from an overall economic standpoint, energy now represents a smaller portion of the average consumer's budget than it did in prior decades. Here's a graph from our friends at ITR Economics illustrating how energy costs take up a smaller share of household budgets today than in the past. This is one of the reasons we do not expect higher energy prices alone to derail the broader economic engine, even though they may be uncomfortable currently. And with that said, we do have a few concerns. First would be an escalation of the conflict. Second, we are concerned that the supply of oil may be much tighter than the futures markets, which substantially controls the price of oil, indicate. If this is true, the negative ripple effects across Asia and Europe primarily would be exacerbated. While we would expect that as the conflict eventually eases or ends, oil prices could settle back down, we do not expect them to get to pre-war levels anytime soon. In the meantime, markets are likely to remain sensitive to developments in the region. Now, turning to interest rates in the Federal Reserve, we still see potential inflationary pressures in the system. Factors like wage growth, housing costs, and geopolitical events can all influence inflation, and these are areas we are monitoring closely. The Fed has begun to cut short-term interest rates, but the story in the bond market is a little more complex. Even as those short-term rates have moved modestly lower, intermediate-term rates have been volatile and actually moved higher. For example, the 10-year U.S. Treasury yield started the year at around 4.16% and, as of this recording, is closer to 4.38%. This divergence between short-term and intermediate-term rates, and the Fed's mandates being somewhat conflicted at this point, are a few reasons we remain uncertain about the path of future Fed rate cuts. Markets are still trying to balance expectations for inflation, growth, and monetary policy. For investors, this environment underscores the importance of thoughtful fixed income positioning and a focus on overall portfolio balance rather than trying to predict every move in interest rates. Looking across the different parts of the economy, most areas are in some stage of a growth phase. There are some notable outliers. Housing and construction, for example, have been under more pressure as higher borrowing costs and affordability challenges weigh on demand. Even with these pockets of weakness, we do not expect a recession over the next couple of years based on the data we are watching today. That doesn't mean there won't be periods of market volatility or economic slowdowns in specific sectors, but the overall backdrop of positive GDP, continued consumer spending, improving business investment, and a relatively healthy job market points to ongoing, if uneven, expansion rather than a broad-based contraction. Against this backdrop, our portfolios continue to perform very well in this environment, and we are very pleased with the level of risk protection they are providing. Our goal has always been to balance participation in growth with a clear-eyed focus on managing risk, especially during periods of heightened uncertainty. We know that headlines about conflict, inflation, and interest rates can be unsettling. It's natural to feel anxious when you see markets react sharply to the news of the day. This is where our long-term philosophy becomes especially important. In the short term, headlines and conflicts can move markets quickly, sometimes in ways that feel disconnected from your everyday experience. Over the long term, however, what has historically mattered most are the fundamentals: economic growth, corporate earnings, innovation, and the discipline of sticking to a well-thought-out financial plan. That's why we continue to emphasize our diversification strategy, thoughtful risk management, and avoiding emotional reactions to short-term market swings. Whipsawing in and out of the market or making big shifts based on headlines alone can often be more damaging than the volatility itself. Now, our team is actively monitoring these developments from the Middle East conflict and energy markets to inflation trends, interest rates, and sector-level shifts in the economy. When and if adjustments are needed to your portfolio, we will make them thoughtfully and with your long-term objectives in mind, not in response to momentary noise. Now, to quickly summarize, the first quarter of 2026 brought a mix of volatility and resilience. The U.S. economy continues to grow, supported by a still strong consumer and improving business investment. Most economic sectors are in a growth phase, even as housing and construction remain challenged. Geopolitical tensions, especially in the Middle East, have created volatility in oil and other commodities, and the U.S. remains relatively insulated from supply disruptions, but not pricing. We see ongoing inflationary pressures and an uncertain path for future Fed rate cuts. Even so, we do not anticipate a recession over the next couple of years based on current data. Through all of this, our focus remains on your long-term financial goals. We're watching events closely and will continue to make adjustments where appropriate, always with an eye toward preserving and growing your wealth over time. We truly appreciate your ongoing relationship with Harvest Financial Advisors and the confidence you place in us. If you have any questions, please do not hesitate to contact our office, and as always, we thank you for your trust.